So you're seeing this is a question from November 2019, question 5 part C is where we left. So it reads that Virgin Industries had issued 72 million ordinary shares as at 31st March 2019. The company had maintained an annual dividend payment of 180 million, including for the year ended 31st March 2019. On 3rd April 2019, the management of the company was awarded a 4-year tender that would cost 720 million shillings. The directors decided to finance the tender by issuance of ordinary shares at par. The return on investment was expected to be 25% per annum on the cost over the next 4 years, ending at 1st March 2023. All earnings would continue to be paid out as dividend to the shareholders. The cost of capital is 20%. So you are required to come up with the value of ordinary shares as at 31st March 2019. The value of ordinary shares as at 31st March 2019. Then number 2, you are required to come up with the value of the company as at 3rd April 2019, assuming that the management made a decision to undertake the investment. Assuming that the management made a decision to undertake these investment. So, when you're given such a question, always remember that the things that you should remember when you are asked of the value of share, value. Then to put a number. So things that you should be knowing. This is general knowledge. Now they want us to get this. They want us to get the value of shares. So in this case, what we have been given, we can first of all have the formula of getting the value of shares using dividend per share and also the cost of capital provided. Using dividend per share and also the cost of capital provided. So you say that value of share is equal to dividend per share over cost of capital. Cost of capital. Now you ask yourself, how do I get the dividend per share? Now, how do I get dividend per share? So dividend per share equal to, will be given by the dividend that was paid, the dividend paid, and then you have to divide that by number of shares. Now I want someone to tell us what is the amount of dividend paid? What is the amount of dividend paid? So that we are able to get, remember already we have the cost of capital. The cost of capital to Conayo. What we don't have is dividend per share. And that is what we are now getting. Dividend per share is given by The dividend paid divided by number of shares. So, what is the amount of dividend paid? 180 million from Brian. 180 million. Just look at the question. You just look at the question. Yeah, the question is direct. The question is direct. So we have 180 million. 180. That is the dividend paid. And then what is our number of shares? Number of shares ni ngapi? Number of shares ni ngapi? Number of shares. The number of shares given, it is 72 million. 72 million. Now, what will be our dividend per share? What will be our dividend per share? What will be our dividend per share? Of course, in million. Of course, in million. What will be our dividend per share as far as this is concerned? 2.5 million, that is 500,000. 500,000. Now, with that information, class, with that information, I'm able to get what the examiner wants. The examiner wants to get the value of shares. Value of shares. Value of shares. So to get the value of share, the value of share, will be equal to my dividend per share, which is 500,000. And then I have to divide by the cost of capital. What is my cost of capital here? What is my cost of capital? I think the examiner had given me the cost of capital. The cost of capital yangu ni ngapi? Cost of capital ni ngapi? 20% or 0.2. I divide by 20% or 0.2. Now give me the value of shares. The value of shares. What will be our value of shares? 12.5 million. 12.5 million. That is 12,500,000. So 500. That's how. Now that is a route that you can follow when you're given the dividend paid. When you are provided with the dividend paid, a number of ordinary share or the number of shares, that is the route that you can get. But now there's also another route here. Now, when you are given the par value, the value of share will be equal to number of shares. This is another way, times the par value. That's also, you also need to note this, because examiner interchanges with. So class, are we together up to that point? Are we together up to that point? As far as that question is concerned, are we together? Are we together? Are we together? Really like to know whether we are together up to that point before we move to the next question. Are we together? Is it clear to everyone? Is it clear? Is it clear to everyone? Okay, thank you so much. So let's move to the other question. I think that's Roman number 2, C2. The C2, we are asked to come up with the value of the company as at 3rd April 2019, assuming that the management made a decision to undertake the investment. If now this company or organization or the management made a decision to move or to undertake this investment, now, what will be the value of the company? Remember, we are under valuation, knowing the value, the worthiness of this business, the worthiness. So, how are we going to handle that? How are we going to handle that? So, the first thing that we have to appreciate is the percentage the percentage of profit after tax. What will be our profit after tax? What will be our profit after tax? That is the first thing that you need to realize here. What will be the percentage of the profit? And then, under which circumstances are we computing this profit after tax? Under which circumstances are we computing the profit after tax? The profit after tax. So, there is a paragraph number 3 there. Paragraph number 3. We are told that the return on investment was expected to be 25% per annum on the cost over the next 4 years, ending that 1st March 2023. Therefore, that is the projection. They have a projection on the return on investment. Therefore, that is the return on investment. Can we be able to get the percentage, the profit after tax, and which item will help us to get that? So we are going to be assisted by the we have number of shares, so profit after tax. So this Roman C2, this one. So profits tax to be the profit after tax. We are going to use the percentage, the growth that this expectation, the return on investment, ROI, was expected to be 25% per annum. So we're going to use ROI times. Now this one, I want somebody to tell us. Our return on investment, this rate of return, which items are we going to multiply with to get our profit after tax? Which item are we going to multiply with? Which item are we going to multiply with to get our results? Which item? Already I can see I have number of shares, cost of investment. What is our cost of investment, by the way? What is our cost of investment? Yes, 720 million. Now, when you compute the ROI on the cost that you have to incur, whatever that you will be having is your profit after tax. That is 720 million. That is very, very good. Very good. Now, this one will give me remember this one is okay. I can just now put it here as 25% of 720. 720,000. Okay, shouldn't be that way. This is a cost of investment. So tunapata ngapi hapa? It's visible. Tunapata ngapi hapo? Okay. How much are we getting? 180 million. Getting 180 million. Yeah, that is our profit. That is our profit after tax. Profit. That means tax is eliminated. Tax is eliminated. Now, I want somebody to remind us. How can now How can we bring this to the present value? To the present, this value. Remember, these are future. They are projecting. These are future value. It's a future value. How can we bring it to the present? We need now to bring this to the present. The concept of our time value of money, the time value of money. How do we convert now this to the present? How do we convert this to the present? How do we convert this to the present? The 180 million as our profit after tax. How do we convert it to the present now? I'm waiting. We use PVPA. Okay. Discounting, still getting responses here. Good responses. We discount. Let's brainstorm. Let's brainstorm so that we are able to see only two individuals contributing to this. Saying discounting. We use PVFA. Remember, PVFA is a factor, a discounting factor. It's a discounting factor. Just look at it. We need now to bring this one to the present. We need to bring it to the present. So we have to, whatever that we are looking at is the present value. People are telling us it's an annuity. Okay, so something. Value divided by number of shares. PVPA, 20% 4 years. We use PVPA. So people are for PVPA. So the value divided by number of shares. Okay, that's sawa. Good insights. So if we are to use PVPA, what is the formula for PVPA? If I can really remember, PVPA. Okay, let's brainstorm things and say PVPA is given by 1 minus 1 plus R raised to power negative n divided by R. That is PVPA. As in when the cash flows are regular or similar. And for sure, I can see that these cash flows are similar each year. So I come here and ask myself, what is my N? Kindly give me N. What is our N? Is it it's something that you know. What is our N? 4. Then what is my R? What is our R? What is our R? In this case, 20%. And I don't have any other unknown. With that, I have the amount that I have to discount. It is 180,000. The amount is 180 million. So with that information, I think you are able to discount this. With that information, you are able to discount this because you say amount is sasa. Hiyo ndio tutakuja hapa tuseme 1 minus 1 plus R raised to negative n. Niza funga Then this one is the one you're dividing by R. We are multiplying this amount with that factor. That factor. So 180 million. I multiply by 1 minus 1.2 because my R is 20%, therefore that is 0.2. And this there one I'm raising to -4. Then I divide by 0.2. Is it visible? Okay. Now, can you give me our present value? Give me present value. $465 and different answers here now. I don't know why. 465, 972. 465. Let's get multiple answers so that we're able to select the one with the majority. The one with the majority, because I can see we have prediction here, but I know shida iko hapa hivi ndio shida iko. So it's 465, 972, 222. Okay, getting any other person? Any other person? That it is clear. So how are you people getting that? First of all, give me this value here. You can use even that a table. Naona hii sasa mimi kwanza nikichukua table. If I pick the table at the end of that paper, hebu tufuate table, hebu tuchukue table. Table inakuwa rahisi, calculator inaweza kumisread. It's good that we meet this again. See, we are like revising the time value of money. So can you look at the table? Go to the PV section. Go to the PV section. Are you there? Are you there? Are you there? The table is always at the end of that past paper. Let me know whether you are there. You know whether you are there. Just look at that table. Rafael, Rafael anatuambia table ilikuwa 2.5887. Okay. Hata calculator, even calculator, if you converted your calculator to 4 decimal places, the value in your calculator to 4 decimal places, I guess that so those who are getting 22222, they're the majority. But let's see. So at the back of the table, at the back of that paper, you can see that for the table we are being given where we have 20%, and then 4 years. So the percentage years. So kuja hapa, so 20 hapa hivi. The value, soma hiyo value iko hapo. Just leave this value here. The value here. I need someone else to read the value. For me, the value 20% hapa on the row column. Then on this column, also Thomas have seen that. Okay. So the value from my end up, if I look at this value, it is 2.2. Yes, 5887. Wakati mwingine tumia hata hiyo table so that you get the exact figure. So that you get the exact figure. So 565 966. So wakati mwingine tumia the table because okay, calculator still will give you that figure, but you need to make sure that you convert that figure to 4 decimal places, because you can see what they use in the table. Because you can see what they use in the table. So nataka kujua kwamba kama kuna mtu hajaelewa hiyo, who have not understood how we are looking at the table, who have not understood, or in other words, are we together now? Are we together now? Comfortable to look the table? The table unaangalia tu hapa. Utaenda tu uangalia is it a PV ama PV. Imeandikwa hapo juu, annuity ama whatever. And then you check which percentage, what is my return, cost of capital. Utakuwa na a percentage na zimeenda hadi 30%. Then check how many years do I have? 5 years. Then the figure hapa adjust yenye intersection. So are we together? Do we know how now to use the table? Okay, say yes. Converting to 4 decimal places. Very important. It is 465, not 5. 4K. Yeah, thank you. Yeah, 465. It is 465, yes. Yeah, converting to, always make sure that you're working with 4 decimal places. 4 decimal places. You can see now the effect that it can bring if you don't work with 4 decimal places. So always in finance, use 4 decimal places. Use 4 decimal places. That is recommended. Na sasa najua kwamba everyone knows how to use the table together and also the calculator. When you use the calculator, please convert that to 4 decimal places. Now, I want us to get the value. The examiner wants us to get the value as a third AP. Is it AP or math? The examiner, yes, third April 2019. What will be the value of the company? Value of the company as that April 2019. Now, this is the current value. Already we have the present value of the profit that the company will have. The present value itakuwa 465. Present value is 465,966,000. That is the present value. That is present value of the profit. Then remember that we had computed the value of shares. And then we had number of shares. That is where we are going to get our next the number of shares is 72. The number of shares that we have is 72. And then we had the value of share. So how much will be the value of share in that section? How much will be the value of share in that section, so that we can add the two, and then we're done. So we are using the 12.5. That is the value here. A minute. We are using the 12.5, and then we have number of share already. We computed number of share. So in fact, we have just to add this date. See, already this one we computed as the value of share. Already we had the value of share here. We add to whatever the present value that we got here. Now we have to add this value of share because we need the value of share this company has at this date. So the value of share here is 12.5. That is 12,500. The value of share. So equal to 500,000. So now the total 6. 476,000. 476,000. 400. So the value of shares of this company itakuwa here. That is the value of share. And then the present value of the profit. This is the profit present value itakuwa here. So when you add the two, remember now that is the word of that company. 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 So are we together? Are we together? Are we together? Are we together up to that point? Are we together? Are we together? Pamoja. Pamoja. So I would like us to look at another question. I would like us to look at another question here. And we see oh, it's, I can see some people are saying it's 478, 466, 478. Oh, 0, 6, 6, 4, 1, 8. Okay. Thank you. So I want us to look at another question here and see how far we can get. So okay, I've seen question here. So Rafael is saying the company decided to undertake 720 million. The value of the value of the company, value of the company. What's your concern, Rafael? Bu elaborate kidogo. Elaborate kidogo. Okay. Will it be right to, if we take 465 minus 720? Okay, let me look at that. On 3rd April 2019, the management of the company was awarded a 4-year tender that would cost 720 million. The directors decided to finance the tender by issuance of ordinary shares at par. So it won't be worthwhile to do that. It won't be worthwhile to do that because you can see this is just a prediction ama a projection. Na sasa ndio maana tumekuja tukaleta ikue present value of the company if they adopt this investment. The present value ya profit yenye watapata, wanaweza pata, tumeileta mpaka itakuwa present. Remember, hiyo yenye tumepewa ni future value. So the present value itakuwa hii. So hiyo kampuni value yake wakichukua hiyo investment itakuwa this one plus now the number of shares or the value of shares, the shares. No companies do have shares. That's now the value of share, the value of share. So I'd like us to look at another question here, still under this topic, and see how we can go about it. Don't know whether you have. I know you have all your past papers. There's a question here which is May 2019 2B. The same. 2B. It's now May 2019, question 2B. May 2019, question 2B. This is also a good one. May 2019. Is it true? Yes, exactly. These are a good one. At least this is a good one. So are we there? Let's see this question as well. May 2019, question number 2B. Okay. Koi, I thought you were sending the question. I've seen you sent a voice. your voice. I see your voice. I thought you were setting question. Now, May 2013. So, are we there? 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 Two people enough to for us to proceed. May 2019, question 2, part B. Huh? Bado hamjafika pale, namna gani? Should be there by now. Remember, when we were starting the semester, we said that all the past papers from 2015 up to 2022, ukuwe nazo either printed ama kuwe kama file, create a file for your computer, ili inakuwa rahisi sana to access them. So I need two people to confirm whether they're there so that we proceed. Okay. Good. So these are still question 1C is under this topic, in that paper. I wish 1C and also question 2B. I don't know whether you can see that. 1C is also under this. Ama tuzifanye zote because hizi zote ni za hii topic. Don't know. I think we should do all. But first of all, let's start with this 2B. Let's start with 2B and then we see whether we can do the 1C, one part C. The question reads, the management of Amani Limited is considering listing at the Security Exchange and intends to undertake valuation of its shares. The following information is provided. The current earning per share, hizi terms uzielewe sana. Earning per share, dividend per share, very, very important. Very, very important. The current earning per share of the firm is 4. That is shillings. The firm has in issue 10 million ordinary shares with a 40% dividend payout ratio. A good question. The firm has an equity capital of 200 million shares with a minimum required rate of return of 18%. And once they give me that, the current theoretical value of the firm's ordinary share using dividend growth model, then 2, XYZ Limited has net tangible assets worth 48 million and a return on assets of 12%. The company expects to receive a profit of 10 million annually for the next 5 years. The company has 2 million outstanding ordinary shares. That question is very, very easy. That question, I think, is a good one for the theoretical value per share using super profit model. Hizo tu ni terms wanatumia to scare the students, but what they need there is the theoretical value per share. Theoretical value per share. Hope you shall review what we did on those content. So that is it. That is it. The first thing they want is the current theoretical value of the firm ordinary share using dividend growth model. Here we can see that we are using just different method. Now the dividend growth model, sijui kama mnakumbuka ni gani dividend growth model. Do you remember? Is it the Gordon's model? Can you remember the formula of the Gordon's model? Do you remember the formula of the Gordon's model? Can you remember the formula of the Gordon's model? Can you remember the formula of the Gordon's model? People you cannot remember. No one who can remember that formula, and it was the easiest. It was the easiest. Okay. To tackle this question, the first thing that we need to compute here, is the net book value of per share, the net book value per share, or the book value per share, the book value per share. Anytime you hear of per, that means division is involved. Per share, per. I don't expect you're looking something to do with per, and then you're multiplying. You see, per share. Per one unit, per that unit. So what will be the book value per share? The book value per share will be, sorry. So you check what you are given by the examiner. You just check what you are given by the examiner. Do we have equity capital? Do we have number of shares? Do we have I don't know, in a chart somewhere. I've seen that somebody cannot access the Zoom. I don't know whether ni kila mtu ama namna gani sasa. So when we have the two that equity capital, you take the equity capital. This one, I need per. So I divide a book value per share. It is the equity that I have, and then I divide by number of shares. Number of shares. In this case, my equity capital is 200 million. Ni mingi sana, divide by 10 million. So what will be my book value per share? What will be my book value per share? What will be my book value per share as far as this is concerned? I can see it's 20, yeah? Is it 20? This will be equal to 20. Of course, Is it 20 million, by the way? Book value per share. Book value per share. Is it? No, it's shillings 20. Shillings 20, yeah? This is shillings 20. So to may reduce. To may reduce is equity capital to this. Now each itakuwa ikitoka 20. Itakuwa ikitoka, yes, shillings 20. So you need to understand what you are looking at. So that is shilling 20. I think I should put it in that order. So from that point, what will be our return on equity? Return on equity. How do we get return on equity in other words? Return on equity is given by earning per share. It is earning per share. This is a formula muhimu. Per share. Earning per share divided by, what do we divide by? Whatever that we have computed, the book value. Book value per share. And then this one you must multiply by 100. Earning per share divided by the book value per share, then you multiply by 100. Then you multiply by 100. Now with that, I know I have book value. This value niko nayo. Hii niko nayo is 20. Now, what is my earning per share? Can you look at the question? Hiyo lazima nikuwe nimepewa. Yaani kwa swali examiner alikuwa amenipatia. Nikisoma, I saw that. Yeah, I have it. The current earning per share. Thank you so much. Thank you so much. The current earning per share ni ngapi? Ni 4. The current earning per share ni ngapi? Ni 4. Therefore, this is easier for me to get the return on equity or to compute the return on equity in this. It's 4 divided by 20. 20 is my book value per share. And then I multiply this one by 100. And I'm going to get, I'm going by 21 by 20. So this is 20%. Yani unaona sasa inakuonyesha ni nini unatafuta. Here we are looking at in a percentage. Return rate of return or return on equity. ROI 20%. 20%. Then remember we need to use the growth rate yenye tumeambiwa, the growth rate. How do we get the growth rate? How do we get, or what is the growth rate? Growth rate. So that we are able now to go to our formula, So the growth is equal to the ROI yenye tumepata hapa, the ROI yenye tumepata ulikuwa na hii. Mnakumbuka, sijui kama mnakumbuka hii term. Who can remember this term? Who can remember this term? We were calling it B. Who can remember this ROI? Naona sasa venye tumeitafuta And then we were multiplying these times what? I wish somebody can remember. We had such a thing. It's like we are doing revision. Kama umekuwa ukifuatilia vizuri, it's like we are revising. This one we were multiplying by. Remember we are given some payout ratio. Yeah? Remember we are told that we are given the payout ratio. Where is that information? Hiyo nilikuwa nimeona mahali. Tumepewa dividend payout ratio ama tumepewa nini? What have we been given? We have been given something. Yeah. Payout ratio tumepewa. Retention ratio. Tumepewa retention ya 40. Let me check. Where is it? Yes. The firm has in issue 10 million ordinary shares with a 40% dividend payout ratio. Tumepewa payout ratio, sio retention. Payout ratio. Therefore, if I'm given the payout ratio, I can now multiply by retention ratio. I think the person who was saying RE. retention ratio. And then for you to get the retention ratio is you take the retention ratio, payout ratio ndio wanalipa. Sasa retention ratio tutapata aje? Tutapata aje? 1 minus that payout ratio, so that you multiply by that. So it will be 1 minus the payout ratio. Hii ni muhimu sana, payout ratio. Sasa hii the 1 minus payout ratio ndio tunaitaga nini? The retention ratio. So I wish now I'm able to have the highlighter, and then this is the retention ratio. So to get our growth rate hapa, growth itakuwa equal to, what is our ROI? ROI tumepata hapa as 20% times, this will be 1 minus 0.4. Itakuwa ngapi? Si ni 0.6 ama 60%. Itakuwa ngapi? Sasa give me my growth. Give me the growth now. Growth tupewe hapo. Tupewe hapo. Tumepeleka chini sana, but haina shida. Tupewe tu growth yetu so that we are able to proceed with the formula. The formula to get the value of share. You're seeing they're giving us 12%. Mimi sasa hapa, I want you people to tell me, are we together up to this point? Hapa hivi. Anytime you are given payout ratio, you have to find the retention ratio, then you multiply by your return on equity to get the growth rate. Lakini still, I told you that there is another formula. There's the other formula of getting growth. Sasa inayo, it's n minus 1. I told you is n. Okay, you can use n minus 1 square root of the current dividend. Hii pia nitatafuta mfano tufanye pia, divide by the earliest dividend. Sasa hii yote minus 1. This is another method ya kutafuta. Sasa when using this method, utakuwa umepewa miaka fulani, 2012, 2013, 2014, 2015, and then dividend zako hapa, dividends. So current dividend itakuwa gani? Hapa umepewa 20, umepewa 10, hapa umepewa 15, hapa umepewa, tuweke gani sasa? Umepewa 5. What is our current dividend hapo? Current dividend hapo itakuwa ngapi? Current dividend itakuwa ngapi? Itakuwa 5. The earliest dividend itakuwa ngapi? Earliest dividend, 20. Sasa kucompute hii ni ngumu kweli. Alafu ukikuja hapa always n is number of years. So I have 4. Na mimi sasa hii, obviously I know that if I have 4, I'll use 3 here. Sitashinda niki, I'll use 3 if I have 4. If I have 5 years, I use 4. Hiyo ndio inamaanisha n minus 1. Because there is that growth. We are looking at growth. What is the growth? So hapa nikiwa na miaka 4 hapa, nitasema 4 minus 1. So hiyo ni miaka 3. Thomas has a question, but before then, hatujamaliza hapa nataka, I want us to be comfortable here. But before then, Thomas, are we together when it comes to computation of growth using this formula? Are we together? Before I respond to that. Good. Now, Thomas is telling us that in the question, we had 18%. We had 18% as Let's look at that question again. That the firm has an equity capital of 200 million with a minimum required rate of return. Thomas, nataka sasa uone hapo the term the examiner is trying to use, with a minimum required rate of return. And then look at whatever that we have computed. It does not mean that we are not going to use that. Maybe there's a section that will be useful. But now, remember, we wanted to compute our growth. And we know that to compute growth, you use the return on equity, that is B. We abbreviated that with B. Then you multiply by the retention ratio. That is why we have gone ahead computing the LOE, the return on equity. So that we are able, you cannot use the cost of capital, Remember, 18% is the cost of capital. You cannot use the cost of capital. That is cost of capital. It's not return. It's not return. Get the difference. Thomas, are we together? Get the difference between the cost and the return. Kuna tofauti kubwa sana. Sijui kama umeelewa something hapo. There's a return and there is cost. Yes. There's a return and there is cost. So for you to compute growth, you use the return. Now you ingine 18 ni cost of capital. 18% ni cost, na hii nayo ni return. Please note that. So with that information, I'm now able to compute the value of shares, but I need to remember the small formula that I had, the value of share, using this method, value of shares. The value of share will be given by DO, which is our DO, we can be termed as the current dividend. So in this case, I don't think we have it, but computing that is simple. DO, I multiply by 1 plus G, and then since I need the value of shares, I have to come and divide with the rate plus growth, rate plus growth. Hiyo itakuwa imenipatia what I need. Now, I like this question. It is almost similar to something that we did. In our class. How do we get the O? Hey, guys, you cannot forget this because we did. How do we get the O? Because we don't have hatuna DO. How do we get DO? I'll give you 1 minute to think about it. Wow. The earning per share times the payout ratio. Sasa nataka muelewe ati retention ratio inakusaidia kupata growth, and then the payout ratio inakusaidia kupata the dividend, the current dividend, the DO. Kila mtu, are we together? Payout ratio haiko hapo kibure. Very important. Just note that. Examiner will use that to make sure that you are taken under the bars. When you are under the bars, what will happen? So it's 40% times 4. So what will be my DO? DO What will be my DO? Hizi zingine naona kama niko nazo. Growth nimepata, R niko nayo. So ni DO tu nahitaji 1.6 from Thomas, 1.6. Sasa with that, I think it's easier for you to get the value of share. Please get the value of share. Take 2 minutes and get the value of share. By 6:25 nadhani leo sijui kama our Muslims wako karibu. I don't know. I see. I think. So by 6:25 we shall have a break of 5 minutes and then we come back. So get the value of shares using the formula now. So you have the formula. This is how is the formula. This is how is the formula. Ndio watu wanapata ngapi? Hapa ni kureplace tu. I have everything. DO. So this value of share. Equal to DO is 1.6. 1 plus G ni ngapi? 0.12 divided by R is 18%. Sasa unaona kwenye tunatumia R plus G 0.12. What will be our brand tuangalie formula vizuri. Tumeandika aje? Value of shares. This formula is okay. This formula is okay. Remember hapa sisi kama hii sio formula yenye tulitumia kwa kutafuta cost. Hii sio formula ya kutafuta cost. Hapana. Sio formula ya kutafuta cost. Ile ya kutafuta cost hata hapa tulikuwa na hapa chini tulikuwa na ni PO the PO minus the flotation or what are you sielewi mnamaanisha nini? Sielewi mnamaanisha nini? Oh, here we put kwani tuliweka nini hapa? Yes. Sorry. Yes. This is negative. Hii ni kutoa. Yes. Thank you for that. And see if we are following. Yes. Our growth rate inaondoa hiyo, so that we are able to get the value. Okay. Now, what are you getting? Are you getting before we break? Yes. It should be. Ya juu ndio tunaongeza 1G. Sijui mnapata nini? Theoretical value tutakuja kuangalia baadaye after a short break. So how much is the value of share? Value of share itakuwa ngapi? Value of share itakuwa ngapi hapo? You can see our time inasonga but divided by 29.87. It's like 30 shillings. Let's say 30 shillings. 30 shillings. So class, yeah, that's okay. So class, let's have a break of let's say 7 minutes. So by 6:35 we are back, and then we complete that. And I would urge you to maybe try to Try to do part 2. Try to do part 2. Then we see. We shall compare what you get. Try to do part 2. So the tangible assets is worth 48 million. 48 million. Then raw return on asset of is it 12%? 12%. Then you told that the company expects to receive a profit of 10 million annually for the next 5 years. So this, okay, expected profit. Let's call it expected profit. This will help us so much to get the goodwill. Najua lazima tutafute goodwill hapa. So expected profit will be 10 million for the next 5 years. N is 5 years. For the next 5 years. According to the forecast, so they had done a forecast. The company has 2 million outstanding ordinary share. Outstanding ordinary share, 2 million. For example, analyze hivi ni muhimu sana. Because you'll be able now to figure out 2 million. Outstanding ordinary share ni 2 million. Required the theoretical value per share using the super profit model. Okay. Hiyo ni jina tu isikushtue. Super profit model is just and remember this theoretical, I'd like to ask, this theoretical value of share is equivalent to what? In other words, ni nini wanataka utafute? It's like the market value, the PO, the theoretical value of shares. So in the same now, PO, the market value. So it is given by the net tangible asset. Tangible asset kama ziko. Tangible asset. Then this one you have to add the goodwill of that company. Add goodwill. Then you can divide this by the number of shares. Number of shares. I hope it's visible. PO, yes, PO. Yeah. So net tangible na tuko nazo hizo. But we have to do some calculations. So how do we get goodwill? Because we have net tangible assets here. Yeah? We don't have goodwill, but number of shares tuko nazo. Outstanding, this one outstanding. So first of all, let's compute goodwill. Goodwill will be computed from this profit. We call it super profit, the expected profit in future, expected profit. So to get goodwill, you'll have to take the super profit or the profit, let's say profit or super profit. Then you multiply by the number of years of purchase. You multiply by number of years. Na hizo zote tumepewa. Lakini sasa you have to understand how now do you convert this ili kuwe super profit mzuri. How do you get your super profit? Super profit. will be equal to the 10 million. Remember, you can use that or use it in that order. 10 million. Then this one, what do we have to do? What do we have to do? What do we have to do? We have to less. I want us to see what is our rate. We have rate, and the rate will be on our tangible assets. Rate will be on our tangible assets. Issued. What is that? What's our rates? Rates ni ngapi? It's 12. Huh? Yeah, we have a rate of 12%. 12%. But now this rate will go to the 12% will affect the 48 million. And the 48 is the tangible asset that we have in this company. The 48 is the tangible asset that we have. Therefore, the rate of return, return is 48, 12% multiplied by 48. That's whatever that you get here, itakuwa the super profit. With that, we'll be able to get our goodwill. Sasa hii itakupatia ngapi? Your 12% of 48, that is like 0.4, 48 times 12. 0.48 times 12. Itakuwa ngapi? 4.24 million. Ushafanya yote, usha subtract 4.24 million. So if that is the super profit that we shall have, the super profit, we can get goodwill. The goodwill will be super profit 4.24 million times the number of years. The years that we have, N is 5. N is 5. N is 5. N is 5. Hope you can see the N is 5. Yes. N is 5. N is 5. So goodwill itakuwa ngapi? The goodwill for this company itakuwa ngapi? The goodwill is 21.2. 0.2 because it's million, million. So with that information, you are able now to compute. Remember, we need the, what do we need? We need the theoretical value. Yeah, the PO. The PO. So PO will be equal to net tangible assets. Net tangible assets 48. Then I add my goodwill, which is 21.2. Then I divide by 2, which is my outstanding obligation. So itakuwa shilingi ngapi? Our market value, market value. Kwa shilingi ngapi? Kwa shilingi ngapi hapo? Kwa shilingi ngapi? 34.2.6. 34.6. 4.6 shares. That's all. The important thing here to understand is this formula. Yani, the moment you find a question with the tangible assets, given the expected profit, you tackle it through this approach. You tackle it through this approach. Tackle it through this approach. Tackle it through this approach. Aha, na wengine wanapata nini? Naona kama ni mtu mmoja amepata. What about the rest? What about the rest? I think you can do this assignment. You can do this assignment. November 2018, question number 2C. November 2018, question number 2C. November 2018, question number 2C. Just open that and try to do it with the remaining 10 minutes. Ni kidogo tu, hiyo haina maneno mengi. November 2018. Question number 2C. Wacha tujaribu hii swali. Kuna zile mahesabu, I'm on this growth, let's say n minus 1, then square root over the current dividend. Lakini remember hii current hiyo tunaita dn. Then the earliest hiyo tunaita do. Then minus 1. Nini hapa unafanya hii kazi? In the question that you'll be having, there's a way you can as well do this. There's a way that you can as well do this. Taking your dn over do, then placing it into 1 over n. 1 over n. Tutaangalia tuone kama tutapata the same thing. Check whether the two will give you the same thing. G is equal to my dn over do. This one, I raised to 1 over n, then I minus 1. Nataka mujaribu the two, and then tell me whether they are giving the same thing. No. So it's always good to have multiple formulas, so that anytime examiner may twist in any way, you'll be able to. So confirm whether the solution yenye utapata hapa, the result ya hapa na hapa the same. Sasa n hapa itakuwa the years, haijatolewa kitu, haijatolewa according to that formula. So attempt that question from November 2020, question number 2C. So dakika 5 hivi, and then we see whether we can